This is the second video in a 3-video series. The first video was about managing your package and how to fill out the form correctly and completely to be able to have a very good presentation at the NCE meeting. This second video is about the annual property operating data sheet, which I think is probably one of the most important forms in the investment analysis process. We analyze the asset and we try to figure out how good this asset is going to perform. And this video is about how to fill out the APOD and make it correct. We're talking about the annual property operating data sheet. Now, this sheet is very important in your analysis of an income producing property. The true and the not so true about the APOD. We'll find out some interesting things about the APOD. In fact, there's 5 things on the APOD to look for, and 3 of them need to be true. So we're selling investments. If it's not your primary resident, then it is an investment. And that investment has certain criteria that comes along with it in the form of the IRS regulations and how you treat the investment. Or it could be a subdivision that's just held for inventory. So what are your investment expectations? I think that when we all look at investment, we have certain expectations. When we look at the property and see what the property is about, the quality of the property, we look at the income and the expenses, we measure the quality of the cash flow. So what's your expectation? Are you looking for cash flow? Are you looking for benefits? What is your expectation when you come to one of these meetings? Now, the CCIM has a really good thing about your expectations, and this is what we all want. We want to be sure that we get our money back, and we want to make a return on our money, appreciation, depreciation, and be able to sell the property at the end of the holding term. So investments come in all classes. There's a lot of different investments, and investments come in all sizes. Here's a package, and the package has actual income, and that's good. And we want actual income because when we have actual income, then we can see what the property is performing at. Now, also, you see I've got a box on there that says, what are these expenses? And we really want to know the expenses because there may be things in the expense statement that are not germane to this property. A lot of times I've seen property owners put in their cell phones and their car insurance or truck insurance or some other item that they would like to gain extra deductions for. And so you want to look at that expense statement to be sure that not only are those things valid for the investment that you are buying and they fit your criteria, but there may be some things that you need to add that the previous owner has not added that would make this investment perform differently. One of those big things is management expense. A lot of owners manage their own property and they don't put a management fee in there. And so that management fee will impact your NOI. Somebody's going to be paid for management. If you're not paying yourself, then you're shorting your investment. Now here's a poor package. You see I've got on the box that why are these 3 the same? When it comes to vacancy factor and it comes to expenses and debt service, all 3 of those are the same on this package. So it looks like the package was just made up and some numbers were plugged in because the system will not let you put in the package unless you have something in these fields. So why are they the same? If you go in and calculate the loan that's on this property, it is not correct. And so really, this package is nothing correct about it. And there is no way that you as an investor can measure this piece of property. Now here's a great package, and it's got links on the right-hand side. You can click on those links and you can get more information about the property. In fact, on these packages, you can probably have 15 or 20 links of different types, PDFs, JPEGs, PNGs, Word documents, Excel documents. You can have all of that in these packages. One thing I like about this package, it has actual income. And also, when I call up a broker, I say, can you send me the income and the expenses I want the expenses, and there's a reason. When you look at the expense statement, you need to see that everything in there is valid for running the building as you would manage it. When you look at the expenses, you want to look for things like the taxes and the insurance and the maintenance and the management fee. And you want to look at other things that may not be part of your investment criteria. And when I'd reconstruct the APOD, then I would take some of those things out. Or I would add a management fee if it needs it. So boom, this is a good package. This is what we look for at the meetings because we're able to measure the quality of this investment. Garbage in, garbage out, and we're going to talk about that in just a little bit. So the annual property operating data sheet is probably one of the most important forms in your toolbox. And it is a tool, and you need to use that tool in the correct way. And don't just fill it out because you have to fill out the blank. It actually has a purpose. And we're talking about the 5 things on the APOD, that 3 of them need to be true. This is the decision maker. I think it's probably one of the most important documents in the process. So 3 of these things on the APOD must be true. So let's look at those and see what it is. So gross operating income, we need that. Vacancy factor, effective scheduled income, less expenses equals NOI. Now, when you work with a lot of these APODs, you see that you'll probably be able to start at the effective gross scheduled income. And that's all the income that property will do. That is the income. So gross operating income, that's usually what's in the market, what's in the neighborhood. And so if you know that, then you can figure out, well, my vacancy factor is probably 5 or 10% in this neighborhood. And so you would use that and you would come up with an effective gross scheduled income. But that income will not be correct because gross operating income and the vacancy factor, everybody has an opinion of what that is in that neighborhood or that area or that building. So to get that effective gross income, you need to look at the seller's income statement and see exactly what the income is that they have received. And then you can back into the vacancy factor and you can back into the gross operating income when you know what the seller has reported on their IRS statement. And then you take out the expenses, and expenses have to be true. So if you don't have management in there and you don't have anything for maintenance hardly because, oh, well, this property is really good shape, and you don't have, maybe your insurance is underinsured, and maybe that you need more for the management fee, like 5 or 6 or 10% management, and you never want to put in the expense statement reserves, and I've seen that in expense statements, and I've seen interest deduction, where they take the interest on the loan and put it in the expense statement and try to deduct that. What that does is it just throws your NOI out of balance, and your NOI then is not true. So the interest deduction and the reserves do not go on this expense statement. And so you have your NOI. And NOI has to be true. So what of these 5 things that you think have to be true? Well, let me give it to you. The effective gross scheduled income is the base. It has to be true or nothing else will be true. Expenses have to be true or your NOI will not be true. And so your NOI needs to be true because that's the basis to start measuring this investment. Everybody will use your NOI, the lender, the appraiser, they will all use that. And so your NOI needs to be true because a lot of people will be using that NOI to measure this investment. And you should too. So gross income less vacancy less expenses equals NOI, and NOI must be true. If NOI is not true, then your whole analysis is not true, and nobody will accept that analysis down the road. And so you're measuring the risk of this property. Low cap rates, that's like riding a shark. Low cap rates leave you very little bit of a margin and you could be bit and bit severely. So how does a lender give low rates? We see those rates, 3, 4, 5. Usually a conventional banker is around 6 or 6.5%. But we see these rates and they are low. So how does the lender do that? Here's how they do it. Stacking the risk, I call it. They have mortgage insurance premium. They escrow for taxes and insurance. They have yearly appraisals. And they have cash calls using the debt coverage ratio. And what that means, if your debt coverage ratio is out of whack, in other words, if they went into a loan at a 1.15 debt coverage ratio, rents go down or interest rates go up, they will call and look at your debt coverage ratio. And if you're out of balance with what they thought it should be, then they will give a cash call and ask you to come in and reduce your outstanding balance down to where your debt coverage ratio is back into their parameters. And they will cross-collateralize your loan, and you may or may not get a new loan renewed in the next 5 or 7 years. So, private money, higher interest rates, and there's a reason for that. And it's private money. They're not insured, no MIP, no escrow account usually. They might have it set up with a loan servicer, and their loan-to-value ratio can be quite a few different things. And then private money, the collateral and the loan-to-value is probably most important. Of course, the credit of the borrower is always important, but they look to the collateral for repayment of their funds if something goes wrong, and usually they want to be in first position. So stacking the risk, what is the seller's view about stacking this risk? Well, I've found that sellers don't really care about your stack, and they want the maximum price. And that brings us back to actual income versus projected income. So when a seller says, nope, I want my maximum price, and you take all your due diligence and you figure out that, oh, well, this property with the rents that are coming in only will yield about a 3 or 4 or 5% cap rate, and that's probably going to be a hard sell. And so what does a broker do? They sell potential. And selling potential is just not true. Your NOI is not true. When they change to potential income and they raise up the rents to where they think it should be, maybe it is based on the market research, but then they forget to also raise up the expenses and the things that take away from that income. And so it's very critical that your NOI is true. Betting on the come, we used to say that, oh, this property will go up 10% every year because it has for the last 20 years. And nowadays we don't say that anymore, even though we're in a market now that prices just keep going up. And so we just keep wondering, how far can we go? But when you're dealing with low cap rates, then you're betting on inflation. And when you bet on inflation, that's a risky bet. You're trying to capture future growth when you're dealing with projected income. But potential does not belong to the seller. If the seller could have captured that potential income, he would have already done it. I don't know of many sellers that will leave dollars on the table when it comes to rent increases. So potential does not belong to the seller. Potential belongs to the person that develops that potential. One of the major things we want to know is, when did I get my money back and what kind of a return can I expect? Actual income versus potential income. With actual income, at least we have a true base to work from. We know what the market is. We know what the rents are, and we can make a good analysis based on actual income and actual expenses. Where with potential income, you're speculating, you're thinking that it could be this, it may not, the market may change overnight, and there's very little guarantee with actual income, except we're working from a solid base of things that are true. So here's the APOD. Gross scheduled income and vacancy factor, those can be manipulated, but when you get down to effective gross income, that's what the seller reported to the IRS. That's their actual income from their actual expense and income statement, and that you can probably rely on. And then your NOI will be true. And when your NOI is true, then your analysis is probably pretty stable. So always get that expense statement, and all you have to do usually is ask. And you take out the fluff. A lot of sellers don't think about it, but car insurance, truck insurance, house insurance, things that do not belong in the expense statement. So take out all that fluff and take out the interest deduction. Don't have reserves in there. And I don't think owners pad the expenses because they're trying to defraud somebody. It is a deduction that they're probably able to take. You only need what it takes to manage that property. That's what should be on your income and your expense statement. Now, what I do is I usually get the income and the expenses from the seller. I look at that, I take out all the fluff, and then I look at their operational costs and I see if that is in line with what I think the operational costs are. And if they don't have a management fee, I will add that in there. If their property repairs are low, I might add extra expense for repairs and maintenance. So I'll try to get to a position of where it just takes what I think it will be to manage the property under my ownership. And so that's what we do. We reconstruct the APOD, and then we go from there. Now, the NOI is the basis of all future analysis of this property, and the NOI needs to be true. And then after the net operating income comes the debt service. Well, they say that debt is a personal thing. When you don't have debt service, then you can pretty well look and you can say, oh, my net operating income translates into a cap rate of 4% or 5% or 6%. So debt's a personal thing, and most of us have to have debt. Cash flow starts with a true NOI and then the debt coverage ratio. Why does a lender want a debt coverage ratio? They say that your debt service can be equal to your NOI. And so if your NOI will handle a certain amount of debt service, the lender says, I want a cushion, and the cushion is 15% or 20% or 25%. And your loan is based off of that debt coverage ratio. So a 1.15 debt coverage ratio means that 100% of the NOI will cover the debt service, and then 15% is your cushion to make sure that you don't get in trouble. Now, the thing about the cash flow analysis, which is the next sheet beyond the APOD, there may not be nothing left after debt service. Can you imagine having a 20-unit apartment complex and 10 water heaters go out, or 10 stoves, or 10 refrigerators? What that bill would be? If you're working on low margin cap rates, then your debt service takes up most of your profit. And so if you've got a very narrow margin and mechanical items go out, you may not have any cash flow for several months, and that can get quite scary. So here's a useful formula, or the ERV formula. I think most people use this formula. But notice that all of this is based on the true NOI. And this is the debt coverage ratio formula. And this debt coverage ratio is how lenders set your loan amount, your annual debt service, and the type of loan that you can get. And so that debt coverage ratio comes after the NOI, cash flow before tax. Now, if you're paying cash for a property, then the cash flow before tax formula takes your equity investment, and your equity investment handles everything that it costs you to get in that property, not just the price of the property, but it also includes your surveys, your title costs, your closing cost, your inspection fees, your broker's fees. It covers all the expenses and the price that you paid for the property. And so you could see that your equity investment in this case is $375,000. Maybe they gave $350,000 for the property. Divide that into your $15,000 cash flow before tax, which is your net operating income, which must be true, and then you get your cash on cash return. It's amazing how sensitive that the cap rates are. I mean, you can take a 1% movement in the cap rate and you can see a dramatic increase or decrease in the price of the property. Now, you can take your HP 12C or your 10B2 I use a program that's called T-Value Online, and it's very quick. And I like that because I can see the movement of the cap rate when I plug in different parameters. So a small movement in a cap rate gives a big price difference. Benefits versus cap rates. We hear that all the time. No matter what it is you're looking for, it starts with a true NOI. A true net operating income is the only way that you will have a valid cash flow analysis. So betting on the future? Used to, we bet on the future all the time, and I see it's still done a lot today. And you're buying potential. You're thinking that, oh, inflation is going to go up at 6% per year or 2%, whatever it's going up. And you think that on the end that you'll be able to come out because of inflation. And that's a premise that a lot of people live by. Betting on the future, buying potential, selling potential. It's all based on inflation. Inflation can change. Inflation can get really high, or there can be no inflation and rents could go down. So betting on the future is kind of a risky business. So all of us are looking for that investment. That's why we come to the meetings. We're looking to measure the risk. We're looking to see what the benefits are. We're looking for that better cap rate. We're looking for something that will improve our client's position. So when things come together, that's when you get the right investment. You can see on the screen that everything about projections is wrong because it's based on what you think or I think, which may or may not be true. But when you have actual income and true NOI, true expenses, then at least you have a basis to work from, and your basis will be accepted by lenders and appraisers and other brokers. So it just makes sense that you get actual income. And there's a place for potential income with new properties, properties that are completely renovated, properties that have not had a tenant in years, and you're projecting some of that income out. But you have to be very careful and very experienced and knowledgeable. And when you are projecting the income, then brokers will probably ask you for some form of guarantee on that net operating income. You don't want to take it at its face value. You would like some assurance that your net operating income that you're actually paying for will be there. Benefits with NOI. Of course, we all want cash flow, but there's other things: appreciation, depreciation, capital gain. So here's two brokers. They're the same. What are you selling and what are you buying? They both have the same product. One's looking for this, the other one's trying to sell you that. Both brokers are looking for the same thing. They're just on the different sides of the transaction. You want to do what? You can see I've got these people up there that they're saying, what in the world are you wanting to do now? Here's my report. Fill out your APOD correctly and completely, have actual income, and it's not that hard to get that actual income. So it's very important when you come to actual versus potential income. So that's my report. See you at the meeting.